And do it from there.
But mind you, if you step up and do it from here, you'll be able to see
the slides. Yeah, rather than sort of going like this.
So why don't you take a, a convenient window and you can just do that.
Okay, all right. Yeah, shall I sit on the end or something then, or another, or close?
Yeah, okay, so I'll sit on the other one.
Or
These are from someone else's panel.
and how long have I got? Sort of 5 minutes?
Yeah. We are fairly relaxed because there's plenty of time on the panel, but if everyone takes 5 minutes, then we don't just fill the whole panel with talking.
I was going to say, it's like my favourite topic, so you're going to need to stop me.
Okay.
Thanks, that's enough for now.
But you've got your slides in the kind of structure, so it can't be.
Yeah, I mean, that's all about fidelity rather than necessarily, the kind of broader thing. But then I sort of set it up with my last slide, hopefully, because it covers the whole corporate national sector.
And I think it was, isn't it, in order?
Oh, I thought it was first, but...
No, you're right. Oh, you are first. Yeah, that works perfectly.
Yeah.
Because, so what I will do then, because I think I'll start the next one.
Yeah.
And then I'll basically swap over.
Shall I sit over here?
Sure. So, and then I'll swap over.
Okay.
And then if you come back down to the slide, and then I'll ask you for what that is.
I think that would be better.
I love a bit of choreography.
On the case studies, I was just mentioning companies, just talk about a couple of sectors and some things I like, things I don't like. Yeah, we like.
Of course. Yeah, I wouldn't expect you to say any more than company in the retail sector, Oh, and they've got another one happening in there. That'd be interesting. Okay.
Salesman, graduate coming in.
Yeah, which was Sophie was actually awesome of here and also the stomach was being very sick. This is supposed to bring back the PTSD. No, I was actually repenting Sophie's cat was on the station. My memory of coming here was going to be to see my brother. Friends just seemed so sophisticated. And then I came back about 5 years ago, lying down, going through, looking at these 20-year-old like babies and getting insecure and slightly smarter
So good morning, everybody. If people could just take their seats, that would be great. We're going to kick off the first panel shortly. So welcome to day 2 of the summit, and I'm very honoured to be chairing the first panel today in this section. My name's Kate Levick. I work for E3G. I'm an Associate Director there for Finance and for Resilience. And I was last here at this event in 2022 on a panel about transition plans. At that time, I was the co-head for the Secretariat for the UK's Transition Plan Task Force, along with Ben Caldecott, who was the other co-head. So things have moved on a lot since then. The Transition Plan Task Force concluded its work. That work is now owned by the IFRS Foundation, and it supports the suite of guidance behind the S1 and S2 sustainability disclosure standards. And you might have seen that the IFRS recently issued guidance on disclosing information about an entity's climate-related transition, including information about transition plans in accordance with IFRS S2, which tells companies how to use the work of the Transition Plan Task Force when they're doing their S2 disclosures. Meanwhile, transition plans were required in the EU, but then the EU has started a process of reviewing its regulatory requirements, which is still ongoing. The UK has just launched its long-awaited consultation on its own transition plan requirement, something it first committed to at COP26 in Glasgow. Since that moment, it's conducted a transition finance market review. It's appointed a transition finance council, which we'll hear a little bit more about today. So transition finance, and as part of that, transition plans are a huge driver of action. And we especially are now seeing this in Asia. For example, Japan has taken a comprehensive ecosystem approach to transition finance. It's published transition finance and transition bond guidance, issued sector roadmaps for high-emitting sectors, and it's now linking transition plans to incentives in the emissions trading scheme and issuing its own sovereign transition bonds to spur the market. So as a result, METI, the Japanese Environment Ministry, recently reported that the private transition finance market exceeds $17 billion US. Meanwhile, in China, stock exchanges are implementing environmental disclosure requirements aligned with the ISSB standards for large listed companies. And different provinces are advancing transition finance in different ways at subnational level in China. For example, China's largest steel-producing region, Hebei province, issued guidelines for transition finance in the iron and steel industry in December 2023. This lists 176 technologies approved for transition finance, and it asks steel companies to make transition plans with targets for 2030 and for 2050. So these had swift uptake, and $2.8 billion of transition loans for steel were issued in Hebei province by the end of 2024. These loans offered price benefits ranging from 5 to 150 basis points lower than similar non-transition finance products, according to a report by the Climate Bonds Initiative. And globally, the market momentum around transition plans continues to grow. They're becoming more of a regulatory norm. There are more than 30 jurisdictions on the path to implementing or otherwise using the ISSB standards, which of course include a transition plan element, with several leading jurisdictions also developing specific transition planning or disclosure guidance. Countries doing that include Australia, Brazil, the EU, Hong Kong, Indonesia, Singapore, and of course the UK. A recent survey showed that 65% of UK corporates think that achieving the goals of their transition plans will make them more competitive. And that's supported by a 2024 survey of 300 global investors, which showed that 63% were allocating or planning to allocate funds to transitioning companies with high emissions, but also a credible transition plan. So the space continues to move fast and to grow fast. And to discuss all of this today, I am delighted to welcome an absolutely fantastic panel. We've got leading experts, leading practitioners who will talk us through the topic from a range of angles. I'm going to bring them in one by one, and then and you'll be able to hear from each of them, and then we'll turn to panel discussion and open up for questions from the floor as well. But we're going to start by hearing from Sophie Brodie. So Sophie's Associate Director for Climate at Fidelity International, where she focuses on climate policy and reporting, engaging with regulators and policymakers on sustainability-related issues that affect both Fidelity and its investee companies. And she's also a member of the UK SIF Policy Committee and the IIGCC EU and UK policy working groups. So Sophie, I think you're going to tell us something about how Fidelity is integrating corporate transition plans into investment decision-making and stewardship. The floor is yours.
Thanks so much, Kate, and thanks everyone today. Yeah, as you said, I'm Sophie Brody from Fidelity, and I cover mostly policy and regulation, but I work with a great set of colleagues at Fidelity who are doing some of the corporate engagement as well. So I'm just going to sort of scene set a little bit today, and I'll just go to the next slide so you can have a look. So just to give you an idea about how Fidelity thinks about transition plans and the ways in which we integrate those into our investment decision making and into our engagement as well. And there are sort of a variety of tools we use on the investment side. So, for example, a transition plan of a particular company will be one input into how we do our ESG ratings, which looks at how companies are managing those specific risks. And those are done by our fundamental analysts. And so it will be one factor. We also think about it in terms of what kind of activities are companies doing as part of their transition plan, and that might come through in one of our sort of other tools, which is an SDG revenues alignment tool. But principally today I'm going to talk to you about our climate rating, because that not only informs the research that we do into companies and how they're managing their climate risks and opportunities, but it also helps us prioritize our engagement as well. So I just wanted to sort of introduce you to it. There will be other asset managers who do something fairly similar. And so the climate rating is designed to demonstrate where the company is on its transition journey. And it's mainly sort of starts as a quantitative tool across these three pillars. So does it disclose emissions? Does it have a target? And what kind of governance has it put in place to manage the process and monitor the progress? There are also qualitative overlays in terms of credibility indicators like the level of capex disclosed and the advocacy that the company's undertaking. But we tend to start with this as a sort of quant basis. And then depending on the sort of outcome of the analysis, the companies will end up in sort of one of these five buckets, each of which has a set of minimum criteria that the company must fulfill before it then moves up to another bucket. This is just, as I said, minimum criteria. There will be lots of other sort of things and milestones that the companies will need to achieve, and that's what we typically engage on. So if I come to the next slide, this sort of gives a better indication of the ways in which it might be used in our stewardship and engagement. And you can see here how it informs some of our thematic engagements, particularly our top emitters. So that's the top sort of 70% of emitters across our portfolios. And the climate rating informs those engagements, particularly how we prioritize across sectors, which are the ones we want to focus on in terms of where they are on their journey, and what kind of disclosure we can expect from them, what kind of policies they have in place, and then what is their record of delivery, how are they getting on with what they've set out to do. We also have some escalation where we feel we've engaged with the companies for a number of years and they haven't quite made the progress that we were thinking they might. And this can include anything from exercising our voting policy, where we have some minimum standards that we would like companies to meet, and these will vary across different parts of the world, but typically align to some of the elements of the rating as well. So I think then if we move on. So once we've prioritized those engagements, we'll set a series of milestones for a company to achieve. And these will be a mixture of sector-specific milestones that we can look across the sector and see how they're doing relative to peers. But also, in terms of our climate engagements, we have hundreds of different milestones that we set for companies depending on the context that they're in. And then we have 4 different stages that we track the milestone on. So typically, research is the first one, so just sort of level setting. Then call to action, stage 2, you can see on the left-hand side. And then 3 is, is the company sort of taking action, and then 4 is disclosure. Is basically we get to a point where we think we can close the engagement. And it won't surprise you to learn that a lot of companies are at stage 2 on the call to action, and we're still engaging with them to understand how they can continue to progress. And this is a sort of sample across our top emitters, hypothetical example. So you can see some of the common themes where companies have achieved the milestones, and then we've sort of closed it off. And you can also see on this side, how that worked. So some did it voluntarily, and some responded to escalation. I think the other thing I just wanted to say is we're very lucky at Fidelity. We have lots of quite deep, long-standing relationships with companies. And therefore, when it comes to engaging on their net zero strategy or the transition plan, we've probably been doing it for quite a while. And we're quite aware, quite quickly, of some of the dependencies and the difficulties that companies face. And that is why we have also put in place sort of system-level stewardship as well to some degree, because quite quickly we find that they're running into technology and policy barriers. And we want to not just recognize those, but sort of support, changes that can help make their transition economic and doable. So that brings me fairly quickly to my last slide, because that's the bit that I look at in terms of the system level stewardship. And so the way the corporate transition plans connect to some of the work that I'm doing, and obviously IREM with the Transition Finance Council is starting to understand how sector transition pathways at country level and perhaps even at regional level can start to support some of those, so bringing down some of those barriers and gaps that the companies are facing and expressing in their corporate transition plans. I'll stop there.
Thank you very much. Thanks very much. This is working, isn't it? So, Sophie, that was really great, and thank you for coming back to the new sitting down mic experience. Can you maybe tell us a little bit more about some of the good practice or the less good practice that you're actually seeing from firms when you apply some of this?
Yeah, sure. Sorry, I'm just getting my notes to just make sure I don't forget it. So I think I sort of looked recently at a couple of sectors. So we take miners, for example. We can fairly quickly see that there are some miners who, they all have the same problem, which the emissions, the bulk of their emissions is in their value chain. And so the way we distinguish good practice from, I suppose, less good practice is where that's been fully recognized. So one of the first things we ask for is Scope 3 disclosure. And then we typically look to see what kind of engagement companies are doing with their supply chain, and we will assess their progress based on those kinds of things. And then I guess another sector that's quite interesting is power, because you have some people in the power sector who are already quite far ahead and actually will probably spend less time looking at those companies and more looking at companies that face barriers but are still putting the measures in place, doing the disclosure, setting the targets based on what's within their control. And those kinds of companies we will ascribe a sort of, maybe even a higher rating to than perhaps just based on their emissions accounting alone.
Brilliant, thank you. Okay, so we're going to introduce our next panelist, and Sophie has lined them up nicely, talking about miners. So Jonathan is the head of climate at Anglo American, Jonathan Dunn, and he's responsible for climate strategy development and implementation across the group. His work covers emissions mitigation, climate engagement and advocacy, aiming to support the company's resilience to a changing climate while ensuring that it's contributing to just transition. So Jonathan, you're obviously working in a hard-to-abate sector, and the mining sector faces particularly intense scrutiny. So what role does transition planning play in Anglo American's approach to navigating that?
Yeah, thanks, Kate. Oh, actually, excellent. You can hear me. I was listening very carefully to what Sophie was about to say to check that we're hopefully in the good practice. Look, thanks for the invitation, and just Firstly, before I answer the question, a couple of words of context, because it's probably helpful, I think, to set the scene. Many of you will not know Anglo American. We're a UK-headquartered diversified mining company. Origins in South Africa, most of our operations currently in Southern Africa and South America. And about a year ago, we announced a strategy, acceleration of a strategy to narrow down our focus into three main commodity groups. That's copper, premium iron ore, and crop nutrition through a project we're building in North Yorkshire, which I can talk about if people are interested in. What that means is we are in the process of either divesting or demerging significant portions of our existing business. So we launched a company called Valterra Platinum onto the Johannesburg Stock Exchange and the London Stock Exchange at the beginning of June, which used to be Anglo American Platinum. So that's been demerged, and we'll be selling our steelmaking coal, our nickel, and our De Beers diamond business, which some of you may have heard of, before probably substantially complete by the first quarter of 2026. I make that as context because it's quite important, and when we think about the transition plan we're preparing, which is thinking about the transition plan for the future company, the company that we will be once those processes are complete. I'd also make a point about mining more generally, because mining has a terrible reputation and is not trusted as a sector at all. And it's relevant, that point. I mean, just one data point, if I may. The International Council of Metals and Mining do some work every year with Globescan. Globescan were mentioned yesterday for some other research, looking at the reputation of mining as a sector against other sectors. And we tend to come bottom or close to bottom every year. And to put it in context, I think this year one of the questions was around positive contribution to society, and we scored worse than tobacco as a sector, which I find it fascinating being in the sector, because I don't think there's another sector which is so fundamental to our daily way of life and so important for the transition, which has such a terrible reputation. And some of that we can debate whether it's a fair reputation or not, but it's a real thing, and it affects trust, which therefore affects the way we think about all of these kind of conversations, including how you present yourself in the transition. So that's your question. Sorry, Kate, but I thought it was helpful context. So in terms of where we are, we've set emissions reduction targets for the first time in 2015. We've continued to evolve those. And currently with the existing company, the one I talked about transitioning away, we have a target which is a 30% reduction on our scopes 1 and 2 by 2030 and carbon neutrality by 2040. And we are committed to halving our scope 3 emissions by 2040 as well. We have, as well as that, a range of the other aspects of what you might consider to be elements of a transition plan within our annual disclosures. And some people have said to me, oh, your transition plan's quite good. And I said, well, I didn't think we'd written one. But we've got different elements of it already, because the nature of what it is about talking about how you're going to go through the transition. But we're in the process of looking. I was involved in the transition plan task force in a little way, and we took the guidance there and thought, actually, let's write a transition plan task force aligned transition plan and think about what this means for us really, really deeply. And so that's what we're doing now. I just want to give you a couple of insights into that process. I can't give you the outcomes because we're not going to publish it until later in the year or early 26, and then we'll put it to a vote at our AGM later on in 2026. But two areas, one on sort of strategy and one on the question of dependencies, and there's a kind of broader way I'd like to talk about dependencies. We thought quite hard what a transition plan means for us, and we didn't want it to just be another disclosure document. We've got plenty of them. I think our sustainability report was 350 pages last year. We don't need more. We need something a little bit different. And we wanted it to be targeted at investors and be unashamedly saying, we think you should invest in us because of the transition. Not a defensive document, but rather invest in Anglo American because of the transition to a low-carbon world. That meant thinking very carefully with our corporate strategy team about making sure what the corporate strategy said aligned with what we're going to say, which it did. I've already talked about the transition of the portfolio. And that's then based on an assumption that A, materials matter to us today, they will matter to us through the transition. In fact, they're fundamental to the transition, and they will matter to us for the long term. And in those areas that I described, copper, people hear about copper and electrification, iron ore, you can't make virgin steel without iron ore. You can make virgin steel without coal. You're going to need iron ore for the long term. You need steel for everything. And then crop nutrition, food systems never gets enough focus, I would contend. But there's a really important point about decarbonising our food systems. So The context strategically, actually, this is about us saying it's not necessarily about our decarbonisation journey, although we will talk about that. It's about what we do as a business, and what we do as a business won't fundamentally change through the transition is our proposition. Quick word, if I may, on critical minerals. A number of people have asked me about critical minerals in the last 24 hours or so, and it's out there in the lexicon. It's something that's in policy and what have you, and it's helpful in one sense of raising the fact of materials mattering. I personally have a problem with it being a bit narrow, because it tends to focus only on the energy transition and excludes things like food systems. It also tends to, because policymakers tend to like to focus on the slightly more exotic aspects of things like cobalt or lithium or rare earths or what have you, and they are important, but actually it doesn't often focus on things like what you do about steel value chains. And we've seen in the questions around what to do with the Scunthorpe steel industry is an insight into something which is perhaps critical in other ways. So it's important and it helps get it into the imagination, but it's not, I think it needs to be thought of as one part of the conversation. Quick word on dependencies, Kate, and then I'll stop, sorry, because I've gone on too long already. We're very conscious that what we're going to do will stay broadly the same. How we do it has to continue to evolve. And there's two different aspects to that. So I mentioned we'll talk about our decarbonisation pathway. But actually, when we think about dependencies, it's not just dependencies on our decarbonisation pathway, it's dependencies on what we're doing as a company more broadly. So will we have the license to continue to do what we need to do to produce the metals that the world needs for a lower carbon future? So on the first of those dependencies, Sophie's already mentioned one example, a technological dependency. We need to transition very big trucks from diesel to a different form of propulsion. It's complicated for all kinds of different reasons, and we depend on the technology evolving in a way which is commercially viable and deployable in a different way at different ones of our assets, and we can get into that more if you want to. But that's one sort of relatively simple dependency. What we're thinking about is saying, well, how do you think about dependencies more broadly? So if you're operating in, for the sake of argument, Chile, and you can see the climate projections which say water is going to be ever more contested, how do you get into a world where you can guarantee that over the next 20, 30, 40, 50 years, which is the life of the assets we can have a relationship both technically with water, if you like, and also with the people who live closest to our operations and around it, such that actually you've got a long-term strategy related to water, which allows us to continue to do what we need to do to produce the copper that the world needs, for example. But more broadly still, if you think about the way in which the just transition is being framed, the just transition has tended to be how you transition away from, for example, coal-fired power or whatever. Actually, there's an aspect of the just transition now which is saying we're worried for communities living near resources that might be developed for critical minerals or copper or whatever. And there's a real risk of the kind of wider good, if you like, of producing those metals and minerals and negatively impacting those people who live closest to them. So we've got to then think, well, what can we do to make sure that in developing those assets, we're developing in the way that are absolutely consistent with stakeholder expectations? I can go into lots of other different bits and pieces. I won't for now. We can come back to it. But just to say, in summary, so we've got a transition plan, we hope to say, which will make us absolutely investable because of what we're going to do for the long term, and crucially, how we're going to do it is going to reduce risk and therefore, hopefully, reduce the cost of capital for us.
Thanks, Jonathan. So you've talked a lot about the stakeholder scrutiny and the stakeholder expectations. So when you're going about building the transition plan as you're doing at present, how has that stakeholder engagement on that been going?
So we've got two different aspects to it, if I may. Well, I said we're making it absolutely clearly an investment proposition. So we've spent some of the most interesting investor engagement conversations I've had in my time at Anglo have been in the process of developing this transition plan. We sat down with 5 of our investors who were either very big on our register or were very interested and engaged on the climate discussion. And we kind of said, look, you know us as a company, you know climate transition, but what do you expect to see from us? What do you expect? And inevitably TPT figured, but it also inevitably every investor's got their own model and everybody's got their own particular interests. So we're going to disappoint people a little bit, I think, because we won't be able to answer every question. But it was super interesting because it was saying, well, look, what we want to see is, do you want the data? Yes, we want the data, but we also want that data set in context. So we want the combination of the story and the data because we want to understand how it all hangs together. And critically, when we asked about things like interdependencies, we said, have you seen this done well? It's one of the questions. We want to learn from others who've done this well. And they said, well, no, but we think perhaps you might come up with some good ideas, which is flattery in some ways, but not particularly helpful when you're thinking about it. And then more widely, I mean, we've got over many decades, we've got a very, very sophisticated way of engaging with, developing relationships with, managing those relationships with all the different stakeholders, most importantly, the people closest to the operations we live in. And I think what we've got to make sure is we're connecting those dots into the work we're doing on the transition plan. So it's very much part of the development of, but crucially the application and the implementation of the plan when we go forward.
Brilliant, thank you. So next we're going to bring in Daisy Stratfield, who can possibly say a little bit more about these investor stakeholder expectations. She's the Sustainability Director at 91, a global investment manager. So in her role, she oversees implementation of the firm-wide sustainability strategy and policies, stewardship, sustainable finance regulation, and development of sustainable products. So Daisy, from your perspective, what makes a transition plan credible, and crucially, what makes it investable?
Thanks. Great to be here, and great to be next to a sort of fellow South African company, because 91 is South African by origin, and we invest a lot in emerging markets, and I think that informs a lot of what we think about when we think about transition plans, and not dissimilar to Sophie and Fidelity. The way we've thought about this is to look at our highest emitters in our portfolio. We're aiming to help the world get towards net zero, to avoid, hopefully, climate risk to our portfolios. But to do that, we really need to understand how our companies can transition and fulfill our key objective, our core objective, which is to generate long-term shareholder value. And we are very mindful of that when thinking about transition assessment. And I don't have a slide, but most of what you've seen on Sophie's slide is not dissimilar to what we have in our transition assessment for companies. We have a 40-indicator transition assessment for our highest emitters, so the companies that cover the top 50% of our emissions, including Anglo, and now a new one. Thank you for spinning out Volterra, who's now appearing in our highest emitters. And we assess each of those companies that are in that top emitters group on this 40-indicator framework, which broadly covers the ambition, what targets are being set, what ambition is there, to what sort of temperature, alignment, disclosure, credibility of the plan, and then implementation of the plan. None of this is particularly new or rocket science. It's all built off Climate Action 100 Plus and TPI and many other things. It's all fairly familiar. But to answer your question about credibility of plan, I think this is an area that is evolving, and there's sort of an interesting bifurcation, and I hope some of the other panelists might start to talk about this, which is we do want those plans to be ambitious. We do want them to be 1.5 degree aligned. That's what we ask for to get your green rating. At the same time, the credibility of being able to do that and deliver shareholder value is getting harder and harder because the world is not on that pathway. So it is not economic, as was referred to, necessarily for companies to do that. So we both need to understand within that plan, you know, where are you on that pathway, on that science-based pathway? What is your ambition? And then how are you going to be able, or how far are you going to be able to get towards that? But also, where are your dependencies to be able to go further or to be able to deliver that truly 1.5 degree aligned? So what we're looking at when we look at kind of the immediate credibility of a plan is, do you have a sufficiently ambitious target for your business as it sort of stands? Are you putting in place the things that can deliver on that target? So if you tell me you have a 30% scope 1 and 2 emissions reduction target, and you say you're going to deliver it by building out renewables, can I see that you are procuring those renewables on a sufficiently accelerated timeframe to reach that target? Do you have those contracts in place? So we have the luxury of being a fundamental research investor, so we are engaging companies, doing deep research into what they say and what they do, so we can see whether they have these things in place. We can ask them. And so it allows us to really dig into, do they have the actions in place, if you like, the component parts to reach the target that they set? Do they look feasible in terms of actually the timeframes over which they intend to do things? Do they have the capability within the organization? If you tell me you are building out renewables, do you have the people who are capable of doing that? Do you have the incentives for your managers to achieve that as part of their KPIs? All of these things build out into a kind of sense of the credibility. And one thing I would really highlight is this point you picked up on the kind of social aspects of this that often are forgotten. If you are doing things that change, you know, what your workforce will be doing, are you bringing your people with you? Are you engaging the communities where you might be if you are transitioning by opening new kinds of mines? Are you going to be able to do that? You know, do we think that's feasible if you have the right community engagement? So there's huge numbers of things depending on what the component parts of that transition or that you're expecting to do are, that could have areas which affect the credibility and the likelihood of delivery. And so we look at all of those component parts and say, do we think this plan is credible, or if not, what are you doing to address kind of increasing the credibility and likelihood of implementation? But this second part that we now have to look at is really on the dependencies. And I don't think we have a good framework for what good looks like there, or how to ask the question. And it's certainly not really clearly built into yet things like the TPT or ISSB, which is, if you tell us you can't set a scope 3 target, fine, I understand some of the reasons why companies say this, or you can't tell us what the target will be beyond 2030, or you can't set a 1.5 degree aligned target, can you also tell us what you would need to be able to move towards that? What is the carbon price you would require? What is the support for technology development that you need? From which governments? What is the offtake price of hydrogen that is required for you to be able to make your hydrogen pilot project then commercial and to scale? And I think there's no sort of template or framework for doing that we have yet, but I think this is, in order to get a more virtuous circle towards 1.5, or getting us back on track, for both investors and companies to have a common view of what is needed and then engage governments on that, is the thing that will get us back to the kind of ambition, so that credibility of what plans are feasible now hopefully continues to move towards that 1.5 pathway, even if we can only really expect companies necessarily to have very clear kind of financeable actions on something that isn't there yet. So I do think this sort of two-part approach is going to be necessary as we move forward, but hopefully that gives a bit of a sense of what we look for in the kind of credibility of the plan piece, and for that to be investable for us, it needs to be able to show how that is going to create shareholder value, how that company is going to be successful in that transition. I think that's where we see the real tension between, being able to deliver a 1.5 target and generate those returns going forward. And to close that gap, we need to address the kind of policy and broader stakeholder environment, hopefully collaboratively with companies.
Brilliant, thanks. And I'm quite struck by how much we're hearing from the panel so far about dependencies, including policy dependencies. Daisy, just a quick follow-up. You touched on your focus particularly on emerging markets, developing economies. Is there anything about that scope and context that makes you sort of look at transition plans in a different way than maybe, a more conventional sort of London-based investor might?
Yeah, I think a couple of things. One is often emerging economies sort of treated like this special case that needs different treatment, or they will have to go slower. A lot of the companies that are the highest emitters and are from emerging markets or operating in emerging markets are global companies. And they will be affected by different aspects. If you take a company like Cemex, they have operations all over the world, including in developed markets. So what pace of transition is right for them? It's not that, you can go this much slower. So I think we have to take each company a little bit where they are as to what's the most ambitious pathway they can achieve and how do we get there. So in one sense, we don't treat emerging markets as a special case. In another way, I think it's really important to do so, because there are some fundamental differences, and often it comes down to how feasible is it, or the other constraints that they may face. And one of our highest emitters that we've been engaging with for a long time is Eskom, South African utility, heavily coal-based. The first stage of our engagement on transition was nothing to do with transition. It was all about how to shore up their balance sheet so they would have the money to be able to transition. And so that kind of doesn't feature anywhere on a transition plan, but is fundamental for that organization, not only to be able to be sort of financially stable and effective as an organization in its own right, but the rest of the South African economy is dependent on that, including a huge number of our other investments. For them to be successful, they have to have access to energy, and that is fundamentally through Eskom. So some of the challenges that are faced and some of the needs of those countries do not necessarily allow a sort of straight line transition. There are many other issues to solve and other contextual issues of access to energy that we have to take into account, which is where that kind of expectation of pace of transition or what you might see in that pathway does vary. But I think that's the advantage of being able to kind of engage companies very closely, have that kind of full sense of the barriers and opportunities, because then you can nuance your expectations, your engagement asks, and you'll show progress, but on a different, potentially a different set of KPIs than you might do for a BP or a Shell.
Thank you, that's really interesting. So something I didn't mention when I opened up the panel is that E3G now hosts something called the International Transition Plan Network, which is a network that's for different jurisdictions all over the world to come together and talk to each other about what they're doing about transition plans, and also exchange with sort of thought leaders and practitioners in this space. We have a lot of participation in that from emerging markets, developing economies. And so I really recognise what you're saying about the investability of transition plans and transition plans as a way to mobilise finance being incredibly important for those jurisdictions. But thank you. Maybe Richard will have more to say about that. We'll move on to Richard Barker, who has been a full-time member of the International Sustainability Standards Board since 2022, and before joining the ISSB served as Deputy Dean and Professor of Accounting right here at the VII Business School, University of Oxford, and in this capacity led Oxford VII's sustainable business initiatives. So I already mentioned that during London Climate Action Week, the IFRS Foundation released new guidance on how companies can disclose information about their transition plans in line with IFRS S2. So Richard, can you tell us a bit more about that, and also why disclosure of transition plan related information is important from the ISSB's perspective?
Right, thank you. Yeah, it's nice to be doing a home gig and not travelling. So let me just reflect first of all on some of the things that have been said so far, because I think there's a lot of encouraging, a lot of common ground, both on how to think about transition plans and what transition plans and planning as a process within capital markets and by corporates can address and what it can't address. So it's a more realistic conversation than would have been the case back at COP26. So for me, there's a tension here, and it's been articulated in different ways by each of the panelists, interestingly. The tension is that you can think about transition planning and transition plans as being all about getting to net zero. I mean, that's the point, right? Ultimately, it's about mitigation. It's about preventing staying within 1.5, which is not going to happen, but staying within whatever we can stay within, kind of thing. So it's all about mitigation. And so it's all about, do entities have a plan to get to net zero, and how can we ensure that they do, and do financial institutions have a net zero target, yada, yada. On the other hand, no, it's not really an exaggeration to say no commercial entity has an objective of getting to net zero as an end in itself. Any entity will have an objective of getting to net zero contingent upon what it is the entity is trying to achieve, returns for shareholders ultimately. And so we have to think about transition planning as conditional, as contextual. Moreover, an entity is not planning, in that context, an entity is not planning to get to net zero as such. It's planning to get to whatever a transitioned future state of the world is. So if we're on a 2.6 degree pathway, which is a much more realistic statement of where we are than a 1.5 degree pathway, then the obligation of an entity is to plan for 2.6. And Daisy, you made this point, not to plan for 1.5. So, and that speaks much more to adaptation than it does to mitigation. So the role of the entity is, given the future state of the world, how do I best position my entity? And anyway, many of the actions that are taken to mitigate are also actions that are taken to adapt. You know, the one action serves both purposes. And in fact, it may be that unless there is a business case to adapt, there is not a business case to mitigate. So the reason I'm saying all of that is that the more that you think about transition planning from a corporate point of view, the harder it becomes to see transition planning as a thing in itself that is all about mitigation and only about mitigation. It's inseparable from everything else. And that's the spirit in which IFRS S2 is written. So IFRS S2 says a couple of things about transition plans and has lots of implications for them. What it says is that if an entity has a transition plan, then it should disclose information about it. So there's no requirement that an entity should have a transition plan, but if it does, and in the same way that S2 says there's no requirement that you have climate-related targets, but if you do, then tell us about them. So this is about the entity reporting about itself and what it is planning to do. There's certainly no requirement that would say, for example, what do you need to do in order to get to a 1.5 degree aligned world? So this is entity-specific reporting on its transition critically, not on its contribution to everybody's transition to 1.5, on the transition that it will undertake. The other broad area of content in S2 is lots of required disclosures that you would expect to find in a transition plan. So most obviously, scope 1, 2, and 3 emissions are required disclosures in S2, and you'd expect to find those in a transition plan. But also, pretty much everything that's in S2 about governance, strategy, risk management, metrics, and targets is the information you would expect to find in a transition plan. So there is a very strong overlap and relationship, as there should be. And I think it's really important, actually, not to think about a transition plan or transition planning as being somehow a separate activity from the rest of the entity. And this comes back to various points that Daisy was just making about dependencies being contingent and so on, and contingent on public policy. Good disclosure by an entity will explain to investors ways in which transition makes economic sense for the entity. And that will not lead to 1.5 degrees, it will lead to a gap. And the gap is the kind of information that needs, the gap provides information about the extent to which there are needs for public policy interventions and behavioral change and everything else. So the role of S2 is capital market oriented, investor oriented. It would include, by the way, Daisy, talking about funding, right? So, if you have an ambition to transition, but you don't have the capital resources to do it, that's part of the disclosure, right? Or if you have a transition plan and you do have the capital resources, or you have a way to raise the capital resources, that's part of the disclosure. So what S2 should do is make much more transparent and much clearer to stakeholders what the entity is planning to do, how it plans to do it, and why it makes sense from the perspective of the financial prospects of the entity to do that. So one more thought. So it's really important not to separate transition plans from strategy more broadly. I think it's also really important that we don't have different views in the market about what transition planning is and what transition plans are, and different rules and different frameworks and different guidance. That can only be harmful. So from an IFRS point of view, being able to take on the work of the Transition Plan Task Force, which by design in the first place was very closely aligned with S2, but expanded upon it, is an incredibly helpful consolidating process within capital markets. So the guidance that we published, whenever it was, 3 weeks ago now, is in the spirit of the IFRS Foundation having a role in consolidating reporting standards globally in this space. Let me stop there.
Great, thanks, Richard. It would be great if you could tell us a little bit more about what you're seeing globally in terms of the uptake of the ISSB standards, and also a little bit, if you are able to share, what's next for the ISSB and for IFRS Foundation in this space.
Yeah, so global uptake, there's somebody in the room somewhere who knows far more about this and much closer to it than I am. There you are, Rose, hello. So catch her at the break if you want the inside scoop. So I think one of the, in many ways for me, the most encouraging thing about the ISSB story so far has been the rate of global uptake. So, we have a role of setting standards, right? But we also have a role to consolidate standards and frameworks that are out there and try to ensure that there is a global baseline. It's so important in this space that there is. I think, in part because of the urgency of transition and so on. In part because good disclosure requires disclosure throughout value chains. You've heard that from the mining sector, for example. Good disclosure requires an understanding of the gap between public policy and private sector and so on. So you need data on a consistent and comparable basis globally to be able to do that kind of work meaningfully. So getting to the global baseline is I think, the most important thing that we can do. We announced a few weeks ago now 36 jurisdictions globally have either already or are already, IFRS sustainability disclosure standards are already required, they're already mandatory required by law. Others are in the final stages of that process. The UK is one of those. So you will have seen, again, 2 or 3 weeks ago, the UK announcing its consultation on UK sustainability disclosure standards, which are essentially S1 and S2 with a UK wrapper. So those 36 jurisdictions include some really significant ones: China, Japan, UK, Korea, Mexico, Brazil, Nigeria, and so on. So the rate of global uptake is very encouraging. What I would also say, the rate of uptake is faster than it was for our sister board, the IASB, when it was first created. But it's the existence of the IASB that enables us to achieve this relatively quickly. So the IASB standards, IFRS, are mandatory in 140 or so countries around the world. The only jurisdiction in which they are not, the only significant jurisdiction in which they're not the sort of the primary standard is the US, where US GAAP remains the dominant standard, although it's very close to IFRS. But critically in the sustainability space, there is no global equivalent to, there is no national jurisdictional equivalent like US GAAP. So there is the potential to achieve that global standardization.
Thank you. And yeah, anything about what might happen next in terms of next standard developments and so on?
Yeah, so in terms of our process, we have 3 work areas right now. One is, the priority one is implementation of S1 and S2. So sustainability reporting is young, it's evolving. Everything we're talking about on the stage right now is all related to S2. Developing market practice in that space is so important. So the Transition Plan Task Force that we've been working, those materials that we've been working together on is all in the context of enhancing the reporting under S2, essentially. So that's our priority, is to get the world off to a good start. There are then 2 separate work streams. One will lead to new IFRS standards in due course, so S3 and S4 and so on. Broadly, there are 2 work streams. They're very broad, and it will take time. So don't hold your breath on this. One work stream is around biodiversity or nature, broadly defined. The other is human capital. There will be a decision at the end of this year about formally going ahead with those 2, setting standards in those 2 spaces. The other work stream, I think, actually is much more important in terms of immediate impact. And that is the SASB standards work that we're currently doing. There are 9 standards that we've just issued as exposure drafts for comment. So the standards have been revised and they've been reissued. Mining is one of those, and oil and gas dominates the rest, and food processing also. So you have standards where sustainability-related risks and opportunities are writ large across those industries. Ideally, what we will get from the consultation is a very high level of input that will enable us to be much more confident that the metrics in those standards are, within those industries, the key metrics that investors and preparers alike need to focus on. If you establish that norm and you build practice around those norms in those industries, it makes life very much easier for the Fidelities and the 91s at this table and around the world to be able to engage with companies on transition plans and so on. So that's the work plan. Brilliant,
thanks, Richard. So everyone's encouraged to go and look at the SASB standards consultation. We've had a wait, but I think you'll agree it was worth it to finally get to Iram. So Iram Yedlin is the Deputy Chair of the Transition Finance Council and the lead member for sustainable finance at the City of London Corporation. She has responsibility for convening key stakeholders to deliver on guidelines, industrial scaling action, and supporting capacity building and collaboration, as well as delivering the UK's sustainable finance offer, in line with the City Corporation's competitiveness strategy and vision. She's also a board director of the Green Finance Institute and the managing partner of ERM Sustainability and Climate Solutions in Northern Europe. So we are very glad she had time to come and be on this panel. ERM, the Transition Finance Council is a relatively new structure. Can you tell us a bit more about what it's been doing over the last few months, what it's achieved so far, and what we can expect to see coming next?
Amazing. Thank you so much. Good morning, everybody. Absolute honor to be here, and it has been going really well so far. Thanks for the invite. Firstly, for those who are from other countries, I might explain you why we are doing this. I think UK government has been quite vocal in their, let's say, new manifesto, not so new anymore, about clean energy, superpower and transition. So UK government, together with the City of London Corporation, agreed to launch the Transition Finance Council in February. And since then, we have been working tirelessly, and I am very happy to tell you what we were up to. But before that, maybe I'll just first of all explain what is transition finance, and I'm sure most of you have an idea, but we're not really talking here about the broader sustainable finance or green finance, as everybody calls. It's more dedicated finance that is aimed at high-emitting businesses who are in need, basically, more action at this point to get to net zero. So my already colleagues mentioned about the challenges and barriers and how transition planning or transition plans are helping or hindering the process. But without money moving, nothing moves. So therefore, the transition finance is critical to, basically, the transition finance market is critical to be established, and UK is trying to be a global hub, given our strength in the financial professional services sector. So the goal of the Council is relying upon these existing strengths and also making sure the transition capital has got integrity and credibility. And UK's, again, infrastructure helps this to evolve, because within the Council's remit, we have real economy participants, finance sector participants, government, regulators, other civil society. So it's like a convening body for everybody to form this market and ultimately take the lead in the world. And to support growth and basically meeting international and corporate climate goals, it is absolutely vital to grow this market. So the Council basically has got also fundamental role for those who may be familiar, but if you're not, the year before, in 2024, there was a transition finance market review, again commissioned by the UK government, and this review came out lots of recommendations what needs to be done. But once you publish the review, usually if there is no custodian of these recommendations or a body that leads delivery of these recommendations, it just fizzles down. So this Council has got the basically role of continuing with those recommendations and implementation of these recommendations. And ultimately, we are also responsible of capacity building, engagement across international stakeholders, so create a little bit of interoperability between countries interested in transition finance. And also we have various working groups. We were so lucky to actually have incredible amount of applicants. So right now we have 3 working groups, and we have roughly 80 people supporting these working groups, and some of them are in this panel. And also we have a steering group who are C-suite executives basically challenging the working group plans. And maybe let me come down to the working groups and what we are doing and what has been published so far. So first of all, we want to be, again, focusing on credibility and integrity. So therefore, we have been very lucky. The reviews chair, Vanessa, stayed on to lead this working group. And we are basically also very lucky that we published already a discussion paper around sort of guidelines, sort of high-level guidelines. And we will be supporting a voluntary following voluntary guidelines and government endorsing those guidelines in a short while. There will be a consultation coming over the summer, and then another one before or around COP. So these guidelines will be published next March. So this has been a process, again, in the making, and there is much to do, but if you are really interested, we do have a website, the discussion paper is on there, and then the consultation will be launched in August. The second working group is pathways again, and policies. So as you are also, I'm sure, very familiar, the likes of GFANs, DESNES, etc., there are already some roadmaps and transition plan examples, etc. But ultimately what we are doing in this work stream is trying to connect the investment angle of these roadmaps. So if you have a roadmap regarding cement, if you have a roadmap regarding housing and so on, so how can the investors have a framework to plug into these net zero roadmaps? So with that, we also published our call for evidence over London Climate Action Week. And this call for evidence is, again, about targeted towards high emitting companies and in terms of credible decarbonization and how we can actually form these roadmaps together with the finance and investment stakeholders. So again, this is online, and if you have great examples or would like to comment on the call for evidence, please feel free to reach out to us. And I think maybe before I just wrap up, I would like to say, so we are absolutely not trying to be another body, another repetition or a talking shop. What we are trying to be is actually staying very pragmatic. So we have heard loads of other countries also trying to develop transition finance markets. So over London Climate Week, we talked to Singapore and UAE, Japan and China and South Africa, so Brazil obviously. And all these markets are trying to do something, but ultimately London, especially UK, given we have a leading role in financial professional services, we have a massive opportunity and a window, short window, time-bound, to really amplify it together with other countries, because obviously given the backlash in the US, some investors do not want to continue investing in that market. So therefore we have to be very opportunistic and keep pushing the agenda.
Brilliant, thanks, Iram. I'm going to open it up to the floor in just a minute, but just to quickly ask you, you've talked a little bit there about how you're speaking to other jurisdictions internationally. But just in general, how are you working with policymakers, whether it's in the UK or international?
Yes, very good. Yeah, I mean, firstly, I guess I can't thank enough. UK government really supports us in this mission. So we have close engagement with government organizations, Treasury, DESNES, Department of Energy and Net Zero. Obviously, we work closely with FCA, PRA, National Wealth Fund. So we already have engagement and ongoing workshops with them in terms of executing our current work plan, but also recently, I think 2 days ago, when Rachel Reeves, our Chancellor, was talking at Mansion House in her annual speech, and as part of the Financial Services Growth and Competitiveness Strategy, cited Transition Finance Council and said, UK decided not to go with the green taxonomy, but instead to work closely with the council and the regulators to actually move the transition finance market to basically unlock further growth. So this is a very good moment, maybe also to highlight. So policy making it also needs to unlock growth. And again, UK talks about unlocking the green energy, creating jobs and reaching net zero faster, but how we can do that is also continuously pushing the policy making. So with that, we definitely work alongside also Net Zero Council of the UK government, emerging markets, developing economies, investor task force, transition plan network, building on all the work has been done already, and also supporting the implementation of ISSB across the board in the UK. And I think, as I mentioned, internationally, there are further dialogue with Brazil. COP30 president was here during the Climate Week. We had several meetings, and also we are feeding into the plans of transition finance topic to be handled during COP. And I would say probably the most exciting news for us next is the upcoming half-yearly progress report, which will be launched mid-September. It's in the government's sort of net zero also implementation timeline. So we will have a publicly facing document which summarizes pretty much everything I said, and hopefully will continue for the next 6 months with a very busy agenda.
Brilliant, thanks very much, Iram. So I'd love to open it up now to the floor, and if you'd like to ask any of our excellent panel a question, please put up your hand. And I'm seeing a few go up already. We have roving mics. So I think we had a couple of ladies on this side, and then some shy people on this side who put their hands up and then put them down again. So yeah, a couple on this side, 3 over here as well. But let's take these 2 first. Thanks.
Hi, I'm Laura from the Church of England Pensions Board. I have a question which will not surprise Jonathan on lobbying. Just thinking about the transition plan comments that have been made here, it was very obvious to me that credibility and dependencies are crucially important, and I heard that come through from basically all of the panelists. My question is actually just on the IFRS standards. So my understanding is, and I'm not an expert on this, but my understanding is with the TPT now going over to IFRS, the policy engagement part of the TPT is now considered part of obviously the TPT, that you would include some kind of disclosures around your lobbying and public policy advocacy. But my understanding is that has maybe not been dropped, but it is not going to be required under IFRS. So I'm just wondering about how you're thinking about that recommendation within TPT to actually ask companies to produce lobbying and policy advocacy disclosures.
Brilliant, thanks. Ideally, I'd like to sort of take those first 5 and then let the panel all have a chance to respond, although I know it's a specific one to Richard, but I suspect other panelists might have a few. Or do you want to just come in quickly?
More for you, actually, with your TPT hat.
Well, I think it's about whether and how IFRS is picking up everything that's in the TPT disclosure materials.
I mean, the IFRS bit's very straightforward. We have no policy role. So our role is not to advocate, not to implement policy, and so on. Our role is transparent disclosure on capital markets of sustainability-related risks and opportunities. So if it's material in that context, it's within scope. But if it's a distinct lobbying public policy role, it's outside scope.
Yeah, fair enough. I mean, I think it's also fair to say the TPT disclosure materials, in which this content's there, they're there in the IFRS Knowledge Hub. They're kind of now IFRS materials. They're pointed to from the new guidance, which itself supports S2. So it's not gone. There isn't like a different IFRS standard that doesn't include it, if that makes sense. But, there's a sort of hierarchy of, well, as Richard said, none of it is a requirement until jurisdictions make it a requirement. So it's a sort of complex network, but it certainly hasn't disappeared, if that's helpful. So the next one, please.
Thank you. Jennifer Anderson, Lazard Asset Management. I'm interested in the comments about systems level stewardship. I know the UXIF report came out recently looking at that, but really keen to hear from the asset managers, what that really means in practice, what they're doing differently, how they're thinking differently, how that looks, what kind of good looks like from that perspective.
And sorry, just come back to the beginning of the question.
Systems level stewardship and what asset managers are doing to implement that and what good looks like.
So Daisy and Sophie, do you want to pick that one up?
Yeah, I'm happy to pick that up. Yes, people are giving it fancy names, systemic stewardship, systems level. To us, it's really connecting the dots between the parts of the ecosystem that need to work, and particularly policy advocacy. And yes, we think about that particularly now where policy isn't necessarily, I think we were all hopeful it would push in one direction, and that would enable transition and companies to take good decisions, and now we don't see that. We do need to think about policy, and we think about it in quite practical terms in terms of where we engage with companies. That's where we have our largest amount of potential influence, but where they face barriers from policy, then we think about what we can do or the ecosystem can do to help shift that policy. A really great example is we have engaged Samsung for a long time on various issues, but now on climate, and it really a large part of their emissions they cannot address unless the Korean energy system decarbonizes, and KEPCO, large sort of state-owned utility. And so we have now started an engagement, because we also own Korean sovereign bonds, with the Korean government around their own, effectively, transition plan and transition of their utility. you can call that systemic engagement. I don't know if it counts under kind of OxSFS report, but yes, we need to join the dots on where the barriers are occurring, and now they are more occurring through policy. Actually, a lot of companies that are significant emitters understand their transition risks. Most of them are doing a variety of things to try and address those, but they are not able to move as fast as we would like to overall mitigate that systemic risk of climate change, and so we need policy to come in, and often there are very direct barriers that we do try and address through that kind of more system-wide approach and thinking.
So, so I can sort of add to that. We do something fairly similar. We start from the basis of our systemic themes, which are climate, nature loss, social disparities, and effective governance. And we start with the company view and, where there are issues that are emerging under those themes. And particularly a lot of the work then actually ends up focusing on climate and nature, because some of those themes are more limited to specific jurisdictions. And then as a global investor, we also look at, where do we have access? Where are there levers that we can join initiatives and support in a way that is not political, but is just trying to support the general ecosystem to move in the right direction to support our companies. And that's why we will engage with standard setters like ISSB, and then with regulators typically on adoption of those standards. Increasingly, though, we are moving into looking at what kind of real economy policy is out there to support particularly the high emitting sectors to have an economic transition. And I think that's where it comes back to the sector transition pathways that the Transition Finance Council is developing, or almost developing a playbook on how those will then be able to be created with a co-creation with government and industry in order to bring investment plans into those sectoral pathways in perhaps a way they haven't done previously. So I would just say it's sort of shifting. There are certain levers that we began to look at, and there are more emerging over time.
Okay, thank you. I know there was a few on this side, so maybe if we can pick these ones up. Thank you.
Thank you, and thank you for the speakers. Very, very interesting. Sam Lucas, Barclays Climate Risk. My question's principally, Richard, sorry again for you, but keen for other panelists to come in as well. So you said very eloquently and maybe rationally what a transition plan should be, right? And companies, entities planning for the future that they think that they will be operating in, and then allowing people to see the gap that perhaps presents. I would argue that that's not in reality what we see from transition plans, which are perhaps a bit more ambitious or idealistic, and the fact that we have credibility scores or parts of the rating of transition plans probably speaks to that. So given that, how can we perhaps make these transition plans more real? Does that facilitate transition finance and growth better? And I'm particularly keen, Jonathan, to hear your views from a practical perspective of, does your transition plan align to that? And if not, why not? And how might it?
Yeah, I think you're making the point that I was trying to make, essentially, that if a company sets a net zero target, let's be net zero, very important, we make a commitment, 2050, and then starts to think about it and starts to realize, what, we can't do that, or it's not. We've heard that on the panel, right? There's more to this, right? And there's an awful lot of contingency in there, even more so for financial institutions holding portfolios, right? So this isn't a commitment we can make. It's a complicated ambition, as it were. And the more realistic that ambition, the greater the credibility of the provider of that information. So what you would expect to find over time with S2 being in practice and with investor pressure asking the kind of questions that you're asking is, no, don't give us some vague aspiration that is not what you're actually going to do. Tell us what makes sense, where there's a business case, right? Tell us what you actually plan to do and why it makes sense. Then we can understand that in context. It's no use to anybody to have plans that are not grounded in anything. So I think we're saying the same thing, essentially.
I actually think it's a brilliant question, and I don't know whether our transition plan will do it yet because we haven't finished it, and I'd love to be able to share more detail, but the framing of the way we've come at it is to say, what do you have to assume for this to be true, and is that assumption real? And is that assumption you're willing to be public on and be tested upon? And if you're coming up with absurd assumptions about what may or may not need to happen in order for you to meet certain targets, then that target's not credible, or that pathway isn't credible. So to give you one example, which I can share with you, we assume on the big truck, the electrification of big trucks, and we've always said this, we think that's something that's going to happen in the 2030s and scale in the 2030s. We think that remains credible today. It could change. It could change in the coming years, but right now we think probably mid-2030s, that's a deployable horizon. We presented that kind of assumption to our executive team and our board. We kicked the tires on it, if you'll pardon the pun, and people are aligned. Okay, so it's reasonable, therefore, to assume that that will be the case. If, on the other hand, you're saying the steel industry is going to be zero emissions by 2035, that would clearly be insane. It's not going to happen. There is no way that's credible. So working out what assumptions you can reasonably build in as a major iron ore producer into what your Scope 3 is going to look like out to 2030, 2040, 2050 is based on a set of assumptions which just have to be aligned with others that are reasonable. So I think for me the transition plan is a perfect vehicle for doing that, because if what you're putting in there is simply incredible, then that should be called out and it shouldn't make it an investable proposition. If what you're saying is absolutely grounded in ambitious reality, not just sort of the reality that we're seeing at the low level, then I think that's where you want to aim for. That would be my view on it anyway.
Just completely agree with that, but also to add, note the importance of comparable disclosure here. So if you have comparable disclosure between Anglo American and Rio Tinto on what it's assuming is credible, I think the questions you ask are absolutely right. Suppose the two are making quite different assumptions, then it's an invitation for Fidelity in 91 to say, well, hang on, one of you is wrong, right? And
Rio will be wrong.
Rio, most certainly, yeah. I took that as given. But and then you build a much stronger sense of both much stronger evidence base, but also a stronger consensus. Well, actually, what is the sector going to do? What is a realistic business case for the industry? And therefore, what else needs to change elsewhere in the economy? So as an input into systemic transition planning, that sort of thinking and disclosure is critical.
Great, thank you. So, brilliant. So we had one over here and then one at the front here.
Hi, Alex Lombos from Client Earth. It's a question for Irem and maybe you, Kate, around whether there's any sign of any UK public funding support for the transition finance architecture that London's trying to set up. And if there's not been much, what kind of public funding policies do you think are needed? And as I ask the question, I'm thinking of Japan and its sovereign bond program, its transition bond sovereign program, which is being recycled to corporate transition plans, and also they've had the central banks had a targeted refinancing scheme for years, providing 0% interest financing to private banks that are providing transition financing. So it's policies like that I'm thinking of as I ask the question.
Mm-hmm. Great, thank you. Well, firstly, I think we need to look into the realistic market circumstances versus also the opportunity itself. So yes, there are countries in the world such as Japan, they came out with basic guidelines for transition in, I think, 2021. They issued their transition bond, I think, last year. But at the same time, I think the scalability is the challenge here. So yes, perhaps there might be a UK sovereign bond issued, but is it actually really hitting the scalability? Because we need to reach to billions that needs to be moved to achieve net zero. So I think from that perspective, yes, there are discussions at the government level how the vehicles, particularly specific transition-related instruments, can be deployed in the market. And also organizations like Green Finance Institute and also GFANS, they have been talking and promoting these solutions for a long, long time. But noting the banks, especially, and investors in Transition Finance Council SteerCo, there is also a desire, not only the instruments or labeling for certain assets, but equally the desire is about having a single source channel into the UK, potentially like a concierge service, so that global markets and global investors can come and understand, okay, how can I invest in this sector? What are the available projects? What are the instruments? What is the guideline for me to actually help transition to happen? So I think we are not there yet, but also there are amazing examples. So you mentioned public-private collaboration. So for instance, UK Infrastructure Bank allocated 24 million equity investment, and totally, I think, roughly 55 million pounds. So it's about lithium extraction plant. And I think these are great examples that private money cannot achieve these things, so it has to be together. Or there are other examples, for instance, 450 million put aside, again, as part of DESNZ's plans in terms of public-private credit to finance companies to actually support those plans that the panel has been talking about. So these are all in motion, maybe not in like huge sort of headline level, but progress is there for sure.
Fantastic, thanks, Iram. I'm not sure I need to add to that. That was such a thorough answer, but thank you very much. And then we have a question at the front here.
So Chris Turpin from Greenings. Thank you to all the panelists. Thank you very much for all your comments so far. It's been extremely interesting. A lot of what I was going to ask has already been answered following the question from the gentleman before last, but I do have a nuance on it that I'm very interested in understanding your views on. Jonathan, the comments you made about seeing an opportunity associated with publishing a commitment and then publishing a plan on the back of it, I think is encouraging and well said. I think it's very important that organisations, corporates do see transition planning as an opportunity if they get it right, as well as a risk. And it then follows that their investors should be able to differentiate between, if they're long-term in terms of their investment horizon, should be able to differentiate between those companies that are doing it well, or thinking about doing it well at least, planning to, and those that are not. That should be a key differentiator in choosing a quality company from a low-quality company. And the comments you made, Daisy, about credibility, which to an extent you've already answered prior to the previous question, it's very important to understand, well, realistically, does the commitment, does the governance around it, does the roadmap, the milestones that underpin it, are they likely to do the job you suggest they're going to do, one, and do they sound practically sensible? And you've answered questions around how you can test that and the role that all of your different, in your variety of different roles, can play in helping to do that. But Daisy, you also made the comment about economic viability, because ultimately, at the end of the day, an asset manager is representing beneficiaries. You're fiduciaries in your own right, any asset manager is. You've got to ensure that whatever the plan's going to be economically viable once implemented. Now, to a large extent, you don't know. So, you know, Richard, you made the comment, it's work in progress, it's an ambition perhaps, probably misquoted you, but it's an ambition that should be realistic. But, you know, the plan might change as the facts do along the way. But to a large extent, as investors, you've got to understand what the likely costs of any transition are likely to be at a micro level and at a macro plan level as well. And I guess my question then is, at a corporate level and also at an investor level, how much information is there that allows you to make an economic appraisal so that you can proactively work with asset managers, Jonathan, to give them assurance that the costs you forecast are ballpark realistic and reasonable associated with each of the plans, and then as asset managers that you can then validate those forecasts so you can get comfortable that they're materially okay. They're not, to the gentleman's point before, too idealistic. They're not going to compromise the business model, because the whole point of this is, of course, you're aiming to reduce your cost of capital long term and generate shareholder value by transitioning effectively. But there must be a myriad of different challenges associated with trying to test the economic viability of a plan. So how do you do that from an asset management perspective, and how do you think about incorporating that into your valuation models so that you can continue to make an informed investment decision?
Wow, that was quite a question. Thank you. And I'm also terribly mindful that we're almost at time, so I think I'm going to try and square the circle by asking each of our panels to just give us, you know, maybe a sort of a 1 minute or so roundup of, what they would see as, some of the next challenges or opportunities in the space. And if they can, while doing that, answer their bit of your question, we'll get basically a bonus prize. So let's start off with Sophie.
Thank you so much for the question. So I think if I just take us back a little bit I will be quick, I'm sorry, but to the beginning of the decade, there was a lot of excitement about what was coming next, particularly after COP26. And I think we saw a lot of companies set targets, get very excited about it, and perhaps there's a little lack of capital discipline. And I think what we've seen over the last few years as companies are actually now trying to implement those plans, we've seen a much greater focus on what is actually achievable. And that has led to some uncomfortable conversations, perhaps. But I think we're now in a more sort of realistic period. And you're kind of seeing the results of that. So I don't want to speak about any sort of particular company, but that's definitely something that we're looking at. But it's something we're always looking at, right? You'd expect our analysts to be on top of that. So hopefully going forward, those things will be priced a bit better. I would just like to say one point in terms of where we're going next. I think adaptation has been mentioned a couple of times. It's on different time horizons, even to transition planning, but it's going to have to be embedded within that. And I think there will be an increasing focus on this time horizon point, even more so than materiality, because that's what's going to define where those different investments happen, in what time frame, and where you can make the case from them versus the cost of acting now and paying one price, and the cost of not acting and paying a different price later. Thanks.
Brilliant, thanks. And Iram?
Yes, so I think cost is important, and what we are also trying to articulate here is if the cost of capital or cost of decarbonization is not reduced, then we won't get anywhere. But also equally we saw, for instance, in terms of solar power, 80% reduction in cost of solar power. So we can't be negative, we need to be hopeful. Also, when we look at investments put towards, at the moment, it's towards 90% mature technologies and only 10% to nascent technologies. So how we can actually encourage the movement towards nascent technologies to grow. And also the other aspect of it is, so I want to also add maybe two things, maybe not directly answering, but it's very important, sort of helping emerging markets to also create their own transition finance instruments and transition related technologies. So again, countries like UK can absolutely do that, supporting those in terms of fostering international partnerships. The other thing is about refinancing, securitization, because if we continue traditional financing methods and expect everything to be given by the government and incentives and credit enhancements, etc., also it's going to slow the timeline. So it's about encouraging investor participation by a little bit of encouragement by the public, and then the private capital will hopefully come back, free up the bank capital to support and enable scaling. So without bank capital coming in, it's also not just possible to rely on the public funding. Thank you.
Thanks, Iram. Richard?
Yeah, so I think we've heard very consistent messages from different perspectives on the panel, and there is an encouraging sense in which we are progressing towards transition plans that are more thought through, more credible, that stand up to there being a business case for them and so on, and that critically are more directly comparable across entities, and critically also that can be aggregated for industries and for the economy as a whole. So the direction of travel, I think, is a very good one. The greater clarity we have on all of that, the more likely it is, I think, we end up with a collective outcome, which is a sort of go back and think again scenario, right? So if the collective picture is one of, well, we're heading towards sort of upper 2-point-something global warming, then probably all the assumptions in the model about the state of the future economy are wrong anyway, so you're going to have to go back and do the numbers again. But also there needs to be stronger collective action to do something about it, in which case you need the realistic corporate level data in the first place as a foundation.
Thank you. Daisy.
Yeah, thanks. And I agree with many of the things that have been said on adaptation, on disclosures, hopefully helping us understand better, have more comparability and move together. I do want to answer your question. I think the great thing about investment managers is we're really, really, really good at doing financial analysis of a company and testing and modelling and forecasting what they're going to be able to deliver. The problem is we do that over the short term. So all of those tools that we currently apply in the short term, I think the key thing we need to do, and maybe it's outside of our individual organisations, to bring some of that into the long term to be able to challenge those longer term assumptions, forecasts in the same way we do, which we don't have many incentives to do within the sort of direct day-to-day. So how do we bring that discipline to really be challenging companies to have those realistic plans? Because I think Sophie was probably referring to a particular company that we know well, who has retrenched on some of their targets. But I don't think many of the pure financial analysts who were looking at that company thought they were going to be able to deliver on those targets. And we therefore need to bring that discipline, that knowledge, rather than stewardship teams saying, tick, 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 doesn't it look like a nice ambitious plan and haven't they disclosed it well, to can we challenge as to whether that's realistic and to make it realistic what needs to happen in the world and work together on that. And I think if we bring some of the disciplines of where investment management is really good at doing that analysis, those forecasts, that challenge, we can actually apply that to the longer term and really hopefully be more influential in how we get there as a kind of collective rather than in maybe individual companies being the, sort of taking the beating on not having a 1.5 degree aligned plan.
Yeah, I thought it was a brilliant question. And I think there's a bit for me, and Richard's touched on this in a different way, we've got to make transition planning a virtuous circle so that there's actually value in doing it, because it's not cost-free. Takes a lot of time, and if it's just another disclosure that makes no difference, then companies will stop doing it, right? So there is value, so let's make sure that value is realized in some way, shape, or form. But I was going to say something very similar about timescales, which is the biggest challenge to your question, I think, because we've been asked many times about CapEx guidance associated with what the transition will cost, and we only guide CapEx for 3 years for everything else. Why would we guide CapEx for a different term just in respect of decarbonisation when so much can change out beyond 3 years? So I think the transition planning process hopefully helps that, in that best practice guidance says you do one every 3 years. That's certainly our intent. We'll do one this year. We can use that thinking about specifics of the plan within 3 years in the context of the direction of travel out to the longer term. Now, it doesn't answer the question specifically, probably that the middle ground. It's not quite the what does it look like at net zero in whatever year you're going for, but it's the bit that's a bit beyond 3 years, which probably needs a bit more granularity, and that's going to be quite difficult to get right. So we're talking a lot to our finance team about how we can present information in a way which is useful without breaking our wider approach to disclosure on finance. But I think it's an absolutely critical point, because the real problem at the moment is the market sending signals. If you put out a big number about how much it's going to cost, your share price tanks, right? And if you suggest that it can be done NPV positive or neutral, people don't think you're credible. So somewhere in the middle, there's got to be a real ground where some of this is going to cost, right? So the question is, where's the money going to come from for it to be paid for, and how do we make that happen? So, but it will take a little bit of time to get right. But I would say that virtuous circle is the critical bit, because if we see really positive reactions to good transition plans, actually reinforcing ultimately, cost of capital, but just simply having clarity of direction, that's going to be a huge step forward, I hope.
Brilliant, thank you. So we should really draw to a close here so as not to squeeze the next panel any further, but I hope you'll all agree that this was a really great discussion and that we learned a lot from all of our fantastic panels. So I'd like to thank them all very much.